Hi, everyone, and welcome to the Goblin Hideout, the NFT Finance Podcast. My name is Terry, and today I'm joined by my co-host Ryan. And today we're speaking with the founder of NFTFi, Stephen. By the way, if you haven't, Stephen has done a ton of interviews with Delphi, Defiant, CoinGecko, BlockCrunch, etc. So even if you have listened to those, we're delving deep into things that haven't been mentioned in those episodes. So yeah, still come on, listen in. Stephen, it's great to see you.
Hey, great to meet you guys too. And thanks for having me on here.
Yeah, of course. And I think to just jump in, you've been asked a lot about background questions and one of the more interesting ones in preparing for this call that I came across is I understand that you were both an artist and software developer. So I guess in high school, you kind of made the decision to go full-time, software development, as it was easier to pay the bills. But I'm curious, what are some of the similarities and differences between, you as an artist and you as a software developer? What are some of the similarities and differences between the two?
Yeah, that's actually a really good question because you're right. I mean, really the only things I paid any attention to in high school was programming and art, just because I found it kind of intrinsically rewarding versus all the other stuff I was doing was just homework that I had to do. And I found them interesting for exactly the same reason, actually. And that's because I think that they're both creative endeavors. So, when you're drawing or painting, you either have an image or a mood or a feeling in mind that you're trying to make real in the world and express to somebody else. And for programming, for me, it was you have this idea in your head and you want to make that a reality in the world. And you kind of type in some code, run a compiler, and all of a sudden this thing that was just something you dreamed up is something that other people can use and experience. And actually, a lot of my initial programming was the way I learned to program was with Logo. That was way back in the day. I'd like to really show my age here, but I think I was 6 at the time when I first experienced it. And Logo was this program where you basically had this little turtle and you can tell it to move forward, backwards, left or right, and do that in loops. So you can make essentially generative art or, generative animations with that. And one of the first programming tasks in high school was basically you'd get this pattern of ASCII characters that you then had to write a program to build. So that scratched both of those itches for me. So that was why I originally got interested in it. Actually working in software development, you end up spending most of your time converting one data type to another data type or dealing with some archaic backend system if you're working at a bank. So, progressively the creative side of it kind of became less and less prominent in my day-to-day career. But the reason I really loved it in the beginning was for exactly the same reason. It was something I could express my creativity in.
That's awesome. Are you still doing any art today, or is it pretty much just startup full time?
Mostly startup full time. I go through phases. When things aren't too crazy with work, then I've got a little bit more energy left to be able to draw and paint. I also did some generative art, over the last couple of years. But really, NFTFi is really when it started taking off, it became really full time. But to that in between having a son, I don't really have all that much spare time left anymore. But hopefully one day I'll get back into it.
Yeah, and congratulations on the kid. As we talked a little bit before, I think this is a good segue into maybe we can do just a quick TLDR of NFTFi, maybe identify some of the key platform participants, and just want to call out, and I don't know if this is fully accurate, so please correct me if I'm wrong, but you guys just surpassed 13,000 loans and greater than 200 million in volume. Is that right?
That's correct. Yeah. So $216 million in volume as of this morning. And just over 13,000 loans.
Congratulations. So maybe just a quick TLDR of the platform and some of the key participants for our listeners.
Yeah, sure. So NFTFi is it's a protocol that allows you to use NFTs as collateral to get a cryptocurrency loan. And it's a fully peer-to-peer protocol. So we don't get involved in any of the underwriting. We don't actually, as a protocol, have any idea what the actual value of the NFT is. We really just allow borrowers and lenders to match up to come to terms on how much the lender is willing to lend on an NFT at any given time. So the way that it works is that a borrower can list their NFT on the platform. Lenders can then make them offers. And those offers consist of a loan period, a loan currency, the loan principal, and a repayment amount. And then borrowers can then choose to accept those. If they accept the loan, the NFT is moved into an escrow contract, and then the borrower has the full loan period to repay, and the interest is fixed. So unlike peer-to-pool protocols, there's no auto liquidations. There's no change of interest rates during the actual loan period. It's always up to the borrower to decide if they want to repay. And then at the end of that period, if they repaid in full, they get back their NFT, and the lender gets the loan principal plus interest. If, on the other hand, they don't repay before the loan period is up, the NFT gets transferred to the lender, and the borrower keeps the loan principal. And then to main participants there are, so borrowers and lenders, obviously. Borrowers, use it for a lot of different reasons. And we're kind of seeing a change in behavior in borrowers between the bull run and the kind of current bear market that we're in. So happy to kind of go into that a little bit. And on the lender side, there's everything from, individuals, some of our biggest lenders are actually individuals making manual offers, to funds, to DAOs like Goldman Sachs, and that are much more kind of professional in what they do and start building direct kind of API level integrations with us to be able to lend at scale.
You mentioned the use cases have become different, and I recall just 2 months ago in the podcast you said I think you delineated all these strategies that people have been using, like margin calls, leverage trades, needing cash, and even donations. Do you have sort of an idea of that, the compositions of these use cases, sort of what's the most popular to the least, and how that has changed over time, as you said, during the bear?
Yeah, so I think it depends a little bit on actual market conditions. So, for a while over the last kind of, 6 months or so, there was a new drop every 2 days. So for a long time, that was one of the big strategies of people using. They have some assets, they want to lever up because they've got a allow-list spot on a mint. They want to buy those items in the mint and then sell on the secondary market to flip, and then hopefully make enough money to repay the loan and end up with a couple of free NFTs. So when drops were very popular, that was a big strategy. Before that, before drops became so it's such a rage, there was this period where the market was pretty inefficient and prices were just shooting up. And a lot of people, especially kind of with CryptoPunks and these kind of OG projects, they bought them for next to nothing and listed them for some price that they thought was crazy. And then the market just started running like mad. And so there were a lot of borrowers who really just wanted to stay liquid so they could take advantage of snapping up mispriced NFTs. But, that lasted for a little while and then that went away, right? So I think there's changing strategies depending on changing market conditions. But the common thing in all of them really is being able to stay liquid without having to sell the underlying asset. In the kind of downturn now, we've seen people starting to use it more as a hedge, where they're looking to basically either take out a loan in DAI, so like USD denominated, or in wrapped Ether, and the wrapped Ether, and they basically use that to cap the downside in case there's another big drop in the market. So they're really using it as a hedge to protect their exposure in terms of Ether and USD.
Got it. That's super interesting, right? Like that's one of the things that we've been studying at Goldman Sachs, is the similarity of payoffs between something like an insurance or deep out of the money put contract and a NFTFi collateralized loan. And on that note, Would you guys ever have plans in, say, like V3, V4 to support like more arbitrarily, say, like repayment dates? Because I know that was something that was supported in V2, or for example,
Yes.
the ability for the premium to be paid upfront, to think deeply more about these replicated payoffs. Because I know you guys said you want to be sort of the settlement layer for NFT finance in general.
Yes. Yes, so that's definitely things that we're considering. I mean, you can almost actually think of our current system more as a sale with a guaranteed buyback price within a specific period, right? But I think things like interest-only loans for longer periods, puts and calls, that's really interesting. Lines of credit, like what we're really seeing develop is, up until NFTs became super popular, cryptocurrencies were really just money. And the only things you could do with them is make more money in a way, right? And then if you wanted to do something with that money that you made, you really have to kind of exit the crypto system and then buy something in the real world or pay for a real world service. And I think what we're starting to see with NFTs now is an actual crypto native market where people actually want to own these assets that are programmable property rights in a way. And we're starting to see this kind of convergence of programmable money and programmable property rights. And really where we see ourselves kind of playing is in the programmable commerce sphere. So how do we put people with capital and put people with assets together so they can do business with each other in this new world that's starting to emerge?
Yeah, that's fascinating because like on one hand, you have expansion of freedom in the settlement layer that allows for more arbitrary transactions. But then I guess I wanted to ask you guys this. On the other hand, it's the type of NFTs that you guys allow to whitelist and transact on the platform that also expands the horizon of what NFTFi can do, right? Like most recently, I think we've seen somewhat of an explosion of financial NFTs since Uni V3. Is there any plans, and how do you guys see these type of NFTs being transacted on the platform?
Yeah, so I think so we really are kind of agnostic to the type of NFT that it is. There's a little bit more complexity when you come to like financial NFTs just because there's more regulation. So we are just, making sure that we don't do anything illegal there. So that's kind of an active research topic for us at the moment. But especially because we're peer-to-peer, we, as long as there's a community that knows how to value these assets, we are happy to support them on the actual platform. I do think potentially some of these financial NFTs are a little bit easier to build algorithmic pricing models on top of. So I do think, some of these peer-to-pool models might be, a better fit for some of these assets. But at the same time, I think having a peer-to-peer model allows you to kind of see how people work and see what they want to do without having to kind of build a very complex system where you encoding the rules of the game directly into the contract at the start. There's this analogy that they use in software and user experience design often, where they talked about there was a university that had to design the paths that go between all of the buildings at the university. And what they did initially is they just planted grass between the buildings and didn't actually pave any roads and just went and looked where people are walking. And that created these kind of footpaths where the grass was worn out. And then once they'd seen what those paths were, then they put paving onto them to kind of smooth out the process and kind of codify, that's the way that these paths are most optimally set up because of how the traffic flows between the buildings. And I think that there's something to be said for just letting the kind of, letting things happen, seeing what patterns emerge, and then building systems that kind of encourage them and make them more efficient and more smooth for everybody involved.
Yeah, that makes a lot of sense. And it was kind of interesting that you mentioned that peer-to-pool would be a better suited use case for this. You've been asked a couple of times, but besides sort of auto liquidations, why are peer-to-pool protocols just not getting the same level of traction as you guys, despite sort of lower interest rates, arbitrary durations in general? Is it because perhaps like PFPs are the dominant NFTs? Like, is that the thesis?
Look, I think part of it, I actually think having fixed interest rate and not having auto liquidations is actually a non-trivial benefit. Like, I do actually think that for collectors, that is a really, really important thing. So I don't think you can just discount that as a reason why they're not picking up so much traction. The other thing, I think, so I've got some ideas around why I don't think in the long term they're actually, like, I think they're set up for systemic failure if they're actually successful. And I'll give you an example. So what is a success? What does success look like for NFT collateralization? Well, you want to kind of at least match what's in the traditional art market, and that's around 10% collateralization ratio for the high value art that's out there. So now if you imagine a pool owning 10% of all the punks in existence, and there's a black swan event like we had recently, and all of a sudden they have to liquidate 10% of punks, that's just going to absolutely crush the market. And, it's going to be very difficult to actually get any of the capital back on that, because you're just trying to sell such a large portion of the collateral of the assets into a bear market where liquidity is already dried up. So I think that's like a hidden danger that a lot of people are overlooking. And then on the other hand, what we're seeing, and we just got back from NFT NYC, and it was very clear to me there is that there are people involved in these trades, and a lot of the what people want especially in the arts and the NFT space is they're actually doing business with each other. They get to know people, they make friends. It is a peer-to-peer economy that's being built there, and taking out that connection actually takes something away from the whole, this whole ecosystem that's being built. So that I think is another key thing. The other thing is, for a peer-to-pool protocol to work, they can really only support the top-end assets, because doing valuations on a longer tail asset that's got more volatility is really, really difficult. Whereas for us, as long as there's a community who supports the project, there's people willing to lend on them. So we can support a whole lot more projects than other people. So I think that's also a key benefit for us. And then ultimately, I think what you're doing in most peer-to-pool protocols is that you're picking a strategy. When you're saying, well, this is the way we think these things should be valued, and this is the risk profile this pool is willing to take. Whereas with peer-to-peer protocols, you allow the market to express different views on like what their strategies are, and some of those strategies aren't purely for the immediate monetary gain of the actual transaction. There's other things involved too. So I think for us, what we really want to be is the platform on which these different views can be expressed. And, there's nothing stopping a pool being a peer in our protocol, right? And in fact, we're working on ways to make that easier for people to do.
Yeah, that makes a lot of sense. I think I agree on all points, right? Like if I'm speculating on a specific like DeFi protocol, I want my liabilities interest rates not to be variable.
Yes.
But also, right, like we've done the math at Goldman Sachs, like we have pretty good analytics here. And a lot of these peer-to-pool protocols are just severely undercharging interest rates to the point where, we fear that some of them are going to be insolvent in like a large drawdown event, as you said.
Yep. And also, the other thing that's interesting to me is that they're paying incentives on both sides of the market and still not getting traction compared to kind of what we're doing, right? So it tells me, like, what I often see is kind of DeFi people coming into NFTs, and they've got an AMM hammer looking for a nail, right? And they're trying to use the same like design principle that worked for money and trying to apply it for something that's just not money, right? So I do think there's a little bit of that going on that side. And then the other thing for me is when you're acting as a lender, like so Goldman Sachs, for example, right? You get full exposure to the upside of every single loan. If you're a pool and you're an LP in that pool and you're trying to do 10% APR, like you need to basically be deploying 100% of your capital to give even remotely attractive rates to LPs in that system, right? So you have to run very, very risky strategies to give enough upside to LPs to make it attractive to them versus just sticking it into like ETH2 staking, for example, right? So I agree with you. I don't know how sustainable these models are, just because these assets are illiquid. They're quite chunky. It's difficult sometimes to liquidate them. You need to be able to potentially hold on to the asset for a little while and wait for the market to recover. And these are just not things that are suitable to an AMM style pool where everything is just purely programmatic.
So, Stephen, to zoom back in a little bit more about what you guys are doing, I do want to talk a little bit more about like the V2 rollout. But before we get into that, I do want to get your take on like what was the thought process behind really the promissory notes? Like you guys didn't need to create this, but it was like a deliberate choice on your part. So I'm curious about that and what went through that thought process. And then further, like you were rolling out the obligation receipts. Can you talk about how those differ from the promissory notes?
Yep. So promissory notes. So what is a promissory note? It's a note that represents the lender's position in an actual loan. And initially the thinking there was just to allow people to exit a loan, if they needed the liquidity. But the other thing that you get from that is it allows you to compose over like the things we're producing in this protocol in a more kind of generic and permissionless way. And if you think about it, actually what we're doing there is it's like you can almost think of NFTFi as a protocol that takes art or non-financial NFTs and turns them into financial NFTs, which then allows you to build derivative products on top of that. So I think that's a very core design principle for us. And we will, any new products we're doing, we think very hard about, okay, how do we allow these things to essentially escape from NFTFi, the protocol, and kind of travel out into the rest of the ecosystem and allow other people to do things with them that we would never think about potentially. And the obligation receipts are the other side of that. At the moment, we're looking at ways to do them in a gas efficient way. The issue is just because gas is so expensive and minting an NFT is so expensive, it becomes, it adds like 20 or 30% to the gas cost. So, so I think we would most likely make those things optional to mint, just so that you don't have to pay the cost of the gas if you don't need the actual obligation receipt. But again, it's just a different way for people to essentially, again, allow these things to escape out of the kind of inner workings of our smart contracts and go out into the wild and have other people build contracts that use them as native primitives in some other system that we haven't thought about yet.
Makes complete sense. So just like enables creativity on anyone using the platform. And
it's also because it encapsulates the whole agreement inside the actual NFT. You don't need to know anything about our smart contracts and how they work, and have extension points in our smart contracts to build things on top of us. So just in software development, you've got this concept of encapsulation. And you want to kind of encapsulate a complex like interaction in typically like a function or an object-oriented programming. And this is just it's just what that concept applied into the blockchain space. And because you now have these abstractions can become ownable, they're way more powerful than they are in normal software development.
So with V2 rollout, like starting out, I guess it was in April, you guys started rolling out V2. What are some of the feature sets outside of, what we've talked about that you're most excited about?
Well, I mean, the most exciting thing for me really is that the system is so extensible, so we're working on a number of new agreement types that, the rollout has been quite a lot of work because we had to go from essentially a single smart contract that does one thing to a system of smart contracts that is easily extendable and allows us to add in new agreement types. But so some of the things that are coming in the near term, like the team is busy at the moment working on loan renegotiations, which will then allow the borrower and lender to agree on new terms and extend the loan without having to first close the loan and kind of restart it, because it's very expensive in gas terms to do that. And that would work very similar to how coming to the initial agreement would work, is either the borrower or lender proposes new terms and then the other party needs to accept those terms or make a counter offer. So you can extend the loan period, increase the amount, change the interest rate. As long as both parties agree, you just modify the terms of the existing loan and kind of move that out into like the new agreement. So that's really exciting to me. We're looking at pro rata loans with a minimum repayment. So that would give people the option to repay early, but at the same time give lenders a way to kind of make sure that they have at least a minimum return. So that's one. And then a whole bunch of other stuff that, we spent most of NFT NYC just speaking to both borrowers and lenders and them coming to tell us, hey, listen, we want to do this deal between ourselves. And we would love if you could add, this feature. So there's a long list of those that we're still kind of pruning and deciding what to build next, but very excited about that. And very excited about the fact that, we'd set up a meeting with a borrower or with a lender, and they'd bring a borrower with and say, hey, listen, this is how we want to work together. Can you help us?
That's awesome. And then I guess going into, some of the people listening in might not be aware about, but can you talk maybe to some of the data insights that you guys have on NFTFi loans and users that might not be, talked about as much?
Yeah, I mean, so first of all, we're adding quite a lot of features in kind of in the medium term that would make this data a little bit more available to people. So one of the things that we've seen is loan durations going down slightly and APRs going up as part of this whole, kind of market conditions that we're currently seeing. And I think what we're kind of seeing there really is almost like the development of or essentially equivalent of the bond market for NFTs. Because if you just look at the price of, recent sales or the floor price on secondary markets, all that's telling you is like a current snapshot on what the current price of these assets are. But, lenders like yourselves, you need to take a risk position on how likely a loan is to be defaulted on over a specific period, which gives you a little bit of a forward look into the outlook of the market, which I think has been really, it's really interesting. And I think it's going to become a very important data point for anybody who's seriously looking at investing in NFTs to start considering. The other thing that we're seeing is, a really big discrepancy in the APRs that you have to pay for different types of assets. So CryptoPunks, the average APR over the last couple of months is kind of in the 10 to 15% range. Bored Apes in the 20 to 25, maybe 30% range. And, less popular assets much higher than that, kind of 40, 50 plus, and I think that's a indication of the risk that lenders are seeing in lending on these assets.
Yeah, absolutely. We even have sort of like a volatility graph or slash like understanding of the ranking of how risky we deem all these assets, right, as a lender.
Yeah, and you just need to be much more rigorous in your estimation of a price when you have a specific period in which you need to make sure that this loan doesn't go underwater, right? So you're getting more and more smart people building more and more sophisticated models to try and look at, what is the trading history of these assets? What's the maximum drawdown over a given period? How much risk are we willing to take on these assets? And then different lenders have different risk profiles and different interests, so some lenders want a default. So they'll get quite aggressive on LTV and give you quite a good APR on those things because they're looking to acquire these assets because they got a long-term positive outlook on them. So I think that's also interesting. There isn't just one strategy that's being expressed in this market.
Right. Yeah, absolutely. Like a limit order too.
Yes.
Just on the note of lenders, you did mention that like traditional art and collectible debt penetration is about 10% earlier on. Where do you see the NFT debt penetration going?
So I think we should at least get to 10%. So there's lots of things that are different about NFTs. So let's just talk about some ranges, right? So, traditional art is, depending who you ask, is between 10 and 20% penetration rates. And if you look at real estate, it's kind of on the 50% range. And I think we'll probably end up somewhere in between there. Real estate is, you can take a very long bond on there. The risks are relatively low. So it makes sense that it's very high penetration rates. Art is, a little bit more difficult to, it's hard. You can only do it really if you've got somebody who can escrow the asset for you. So, either it's in a gallery or a museum or in a free port. Doing an actual repossession of that asset is quite expensive. How do you make sure that you can't do it cross jurisdiction? So the transaction costs of doing these loans is quite high. So my guess is that we're somewhere in the middle of those two for NFTs in general. At the moment, I think the limiting factor isn't liquidity. I think there's a lot of liquidity waiting to find yield because it's all kind of disappeared out of the DeFi landscape because of current market conditions. But I think the limiting factor is just that a lot of people who own these NFTs haven't, the large portion of them haven't ever really owned high value assets before. They've NFTs is kind of the first thing that they've experienced that with. And they don't have that. It's not even in their heads that they can use these things as financial assets to achieve other things. And then I also think, given, it's still super early, there's still a lot of products that we need to kind of build in this space. So one of the things we're looking at is an interest only loan that can be much longer, so that you can still avoid forced liquidations, but and the kind of settlement of a defaulted loan is still like nice and simple, but you can do much longer loans. So we've had a number of people come to us and say, hey, listen, I own, 10 CryptoPunks and 3 autoglyphs. I want to buy an apartment. I don't want to go to the bank to get a loan. Can I take out a 5-year loan and just pay the interest using these things as collateral? So I think over time, you'll see more and more of those things happening. So yeah, I don't know if that answers your question, but I think it's a long journey for us. There's going to be lots of education. It's going to be lots of listening to the market and building the products that people are asking us for. And as you keep doing that, there's going to be more and more use cases that make sense to use these assets in.
Yeah, that makes a lot of sense. And especially internally, how we think about the NFT finance market in general is kind of a conditional bet, right? Like, do PFPs just stay the market size they currently are? Do they increase in size? Are there additional NFTs brought sort of to mainstream, like financial NFTs? On top of that, right, I think bubbling up right now is this idea, or has always been every cycle, but somehow gaining a little more traction this cycle, is this idea of real world assets on chain. And once that's a reality, right, like NFT finance becomes a significantly larger opportunity.
Yes.
And on that note, like, what is your opinion on real world assets on chain? Like, do you think that will be sort of that would be a venue towards which we sort of
yes, I mean, I definitely think so. I mean, whenever you start kind of touching the real world with blockchains, things get complicated. So I do think those are like relatively difficult problems to solve. But I think there are some subsectors that are actually not that difficult. So I'll give you an example. High value Swiss watches. Most of them are bought, stuck in a vault, and then they just sit around for 5 years until the price goes up, and then people sell them on in the secondary market. So they're really used very similar to like speculating on NFTs. Excuse me. But if you think about that, as the watchmaker, you're missing out on all of the secondary market value that kind of gets created on top of your initial sale, right? So if I'm a maker of luxury watches, I've got a warehouse anyway. I know that somebody's going to buy this watch and just stick it into a different warehouse. What's stopping me from minting an NFT that the owner of the NFT can burn and in return receive the actual physical watch? I custody it for you in my warehouse and, take a cut of all the secondary sales of the NFT as it trades on a liquid market. So that cuts out a lot of the complexity involved in building a fully decentralized custodying system for real world assets. And it's like a very clear business, use case for these companies. A lot of them are quite slow moving, so I think it might be a while for them to catch on. But you can do the same for sneakers. There's all of these, secondary markets for rare sneakers. That makes complete sense to do that. Free ports, where most art in the world actually live. It's basically the art is in a warehouse in a free port, which is a free port is like a warehouse that's essentially not in any country. It's in like international waters in special areas inside airports. Before tax reasons. So people leave a lot of high value art in a free port. It's a great business model add on for a free port to be able to say, hey, well, we'll mint you an NFT that represents ownership of this asset in our warehouse, and that can trade freely on the secondary markets. And we can take a cut of the secondary volumes there. So I do think it's going to come. So that's definitely something interesting to me. But I think more broadly, what is an NFT really? And if you go down to if you're looking at the code of what it actually is, it's a unique, ownable digital thing, right? So that you can program the property rights on. And if you think about it like that, it can really be absolutely anything. In the same way that, a web page can be Google, or it can be Facebook, or it can be, a site to kind of order your food, when you're hungry at night, right? It's the primitive is so broadly applicable. I really think we've just started scratching the surface of this. And if you think about the use cases that are currently popular, mostly these ones are found product market fit because of the limitations of the current crop of blockchains. Like, why is art so popular, and why did it gain traction first? Well, it's relatively high value stuff. You mint it once, it trades fairly irregularly, and the most important thing in that space is provenance and knowing that that it's the original, right? So you don't need high throughput blockchains to make that work. But as blockchains become faster and we kind of get more used to owning digital items, the things that are represented as an NFT, the design space is almost infinite, much broader than money. You only get so many kinds of monies. But, unique things, there are literally billions of in the real world. And I think we'll see the same developing over time in the kind of NFT and crypto space.
I think this is a perfect segue into a line of questioning on how you guys think about products. So really, in such a new space and speculative space, how do you guys determine what users will really, love from a product standpoint? And then on top of that, is there any plan for NFTFi to do other forms of products other than just collateralized loans and its natural extensions?
Yeah, so my background is, so I was a programmer for a long time, but like I said, I was starting to get bored because, there's only so many times you can kind of integrate with some, bank system before you kind of lose your mind. So I eventually moved out of that into like the product space. So really for us, it's fully product led. So, part of the place where we got this idea from is that there was a spreadsheet floating around kind of in late 2019 where some kind of like OG collectors were keeping track of, this person owes this person this much, and if they don't repay by this date, they will give them this NFT. So we knew that there was a product there, and we started from like, well, what would that look like in the user interface? and then work backwards to what smart contract do we need to build to make that work. And that's exactly how we're approaching things now. Like I said, at NFT NYC, we had both borrowers and lenders coming to us and saying, hey, we really want to do this. And then we start thinking about, okay, cool, let's design that from a product point of view. Who should be paying? Who's making the value here? How do we make this usable and easy to use? And then we back into what the smart contract design needs to be to make that happen. So we don't come up with some clever design that we then go look for people to try and use. We listen to what people are saying to us, and then we build that. So, and the list of things people have asked us to build is super long. So the main thing for us really to do is figure out what to build first.
That's great. And then getting closer to closing out the episode, but I do want to touch base on the future of NFTFi, and specifically the path of going down the DAO route. So I know previously in other conversations you've talked about. So I guess you were a founder of an exchange, and I'm curious how that impacted your views of decentralization. First, and then also on top of that, so how does the idea of really progressive decentralization influence the creation of the NFTFi DAO?
Yeah, so what did I see kind of in the exchange times? Well, so one of the things that I saw back then, I don't know if you guys were paying attention to that space at the time, but there was this notion of, what do they call it? Transaction mining, which is essentially paying incentives to people to do volumes on in exchange. And you would see a new exchange pop up every 2 weeks. They would shoot up to the top of the exchange with the highest volume because people were wash trading to farm the token, and then just basically sell it on the open market to make a profit. So one of the reasons we've been quite slow around producing a token and paying people to use our product is because free money always has product market fit, right? If you're giving people money to use your system, they're gonna use your system. So for us, it's quite important to figure out will people use what we're building if we don't pay them to use it, right? So I think that's one thing that I learned in that space is that incentives can hide the fact that you don't have product market fit, and once those incentives run out, often what you end up with is no more tokens and no actual users, because they've gone on to the next thing that they're kind of mining and farming. So that's one thing. I do think that there is, especially if you want to kind of be the settlement layer for these kinds of transactions, I do think decentralization is important. I do think it aligns incentives better. But at the same time, there's a price that you pay for decentralization. So first of all, it's more complex to build these things. And again, from having a product background, I know that, at least half, if you're a really, really good product person, at least half the stuff you build is going to be wrong and you're going to have to change it anyway, right? So you don't want to pay all of the decentralization costs for things that might not work. You want to kind of figure out what works and then figure out how to decentralize it. So that's maybe something that I think about slightly differently to other people in the space. And then I think the third thing that can be quite difficult, and you see it happening quite a lot in projects, is once they go fully decentralized, they often tend to kind of ossify into a fixed way of doing things, just because it's really difficult to get a big group of people to all agree on what the next thing to do is. So I do think that there is value in having a core team who've got a strong vision on how to kind of push this space forward. So the way that I think about it in a way is almost, how can NFTFi as a company show an example of how to build product on top of NFTFi, the protocol, and then create ways for other companies to do that and build a kind of viable, sustainable business. And how do we create those hooks for other people to build on top of? how do we create tools that allow other people to kind of build on top of the protocol. And then over the long run, I think you want to have multiple for-profit companies making a living by extending the protocol that is owned by the community.
I'd like to say, I think more and more people are starting to come around to kind of like the ideation of what you just kind of communicated. At least I am personally, after spending a lot of time kind of like working in DAOs and helping launch DAOs. So it's a very challenging problem and constantly evolving. So last one for me is, how is really the ambassador program going to shape the future of the NFTFi DAO? And I would imagine these are going to be kind of the future leaders within the community.
Yeah, I mean, like we keep talking about how privileged we are to have, the caliber of people who are working as ambassadors, working with us. So a lot of these people are, I don't know that I could have hired them or afforded to hire them, so it really is, I think, one of our superpowers, and one of the things that I think, we really need to figure out, how do we scale this in a way that allows them to, like you said, be the leaders in the community. And, part of, so I think we've got a few types of ambassadors. We've got educators and moderators and like developers, but I think that there's also things like product builders and deal makers and marketers and all of these kinds of things that are roles and departments that you have inside a organization that need to be filled inside a DAO or a distributed community. So we are thinking quite hard about how you do that and how do you, so that's very much a community endeavor. And like one of the things I've been thinking about quite a lot, especially being in the NFT space is, in a way, I think NFTs are better at building a community, but I think ERC20s are better at governing like the financial kind of decisions of a protocol. And so what we're thinking about really hard, like deeply, is how do you merge those two in a way where they're additive instead of one taking away from the other one. I don't think anybody has really cracked that problem yet, but it is something that I'm thinking about a lot.
And on the note of community, we do want to round it out and just like thank you guys for your time. But before we end it, like where can people go to learn more about NFTFi and how can people get involved?
Yeah, so you can either check us out on our website, which is nftfi.com, or on Twitter, also at NFTFi. There's links on there to the Discord. So, lots of activity in the Discord. You guys are very active in there too. There's a really kind of a lot of very smart people that are, very willing to help new people kind of get into the space and understand, what's required to like operate safely in this environment. So yeah, we'd love to see everybody in there.
Awesome. Thank you for your time.
We really appreciate. Thanks a bunch, Stephen.
Thank you very much for having me. It was a really interesting conversation. I have to say, it's some of the better questions have been asked and, made me think more deeply than I normally have to.
Follow me on Twitter. I'm 0xTayTayHoHo on Twitter. That's Tay with an E. And you can follow Ryan at _Helmass.
Yeah, and that's _HELMASS. Thanks everyone for tuning in, and we'll catch you soon.